Welcome to this chapter. So, here we're going to look at valuation and rates of return. So, this chapter provides us with an opportunity to apply time value of money concept. Now, if you remember, in time value of money, we learned about the present value, whether the present value of a single amount or the present value of annuity. We also learned about the future value of a single amount and the future value of an annuity. We also learned about the yield to maturity, which is again is same thing we're referring to here in terms of rates of return. And we also learned about the number of periods that you need to consider when it comes to discounting cash flows. So in this chapter, then, the one thing we are carrying away from the previous chapter is this concept of present value. And in this chapter, for example, when it comes to determining the price or the value of a bond, then we are interested in the present value of an annuity and the present value of a single amount for dollar. So those two are going to help us in trying to determine the value of the asset. So as we cover the chapter, just keep in mind the valuation of any financial instrument, financial asset, is going to be based on the present value of the cash flows. So if we're going to value a bond, if you're going to value common stock, or if you're going to value preferred stock, then what we are saying is we need to know the future cash flows for those assets. Very important. We also need to know the required rate of return. Now, think about it. If you are the provider of funds, then you demand a required rate of return. If you are the borrower, if you're the borrower, to you, it becomes what you call the cost of capital. So the borrower is the cost of capital to the provider of funds. It's basically a required rate of return. And therefore, the required rate of return that we will be using to value the asset is based on the risk involved and the number of risk involved when it comes to the required rate of return. So just keep in mind for any required rate of return. So let me just say this. For any required rate of return, it's made up of either the risk-free rate plus the inflation premium plus the default risk premium plus the liquidity premium and also the maturity risk premium. All these components make up the required rate of return. It just depends the nature of the instrument. Some instruments like a treasury security, a short-term treasury security will only consist of the risk-free rate and the inflation premium. You know, but a more long security like a 10-year security, for example a corporate bond, then you'll find it tend to exhibit most of these characteristics if it's a long term like a 10-year corporate bond. But just keep in mind it depends on the risk involved. Some risk will be again inflation premium, default risk premium, maturity risk premium are some of the examples of risk that are inherent in any given security. So bond valuation is based on the process of determining the present value of interest payment plus the present value of the principal payment at maturity. And a good example of this is the bond. When you have a bond, what the bond is doing this for a bond, when you buy a bond, you pay a particular price. Let's say we have a bond that has a face value of 1,000. This bond has a coupon rate of 10%. And let's say this bond matures in 20 years. And today in the marketplace, the yield to maturity, or what we call the market rate, let's assume the market rate is 8%. So what we are saying here is this bond, being an instrument, when you buy a bond, then the bond promises to pay you interest payments, and then at maturity, the bond returns the face value, which is $1,000. So at maturity, this is in 20 years. So 1 year, second year, third year, all along until the 20th year, this bond is going to pay you interest, and the interest is based on the coupon rate. Sometimes we say the stated rate, sometimes we call this nominal rate or a quoted rate. I think it's same thing. It's been referred to here. Is basically the interest rate for this particular instrument. So the interest will be equal to the coupon rate, which is 10%. So it will be the coupon rate times the face value. In this example, it is 10% times 1,000, because this bond has a face value of 1,000, and therefore every year this bond is promising to pay you $100 every year. And these are the cash flows. Every year it's $100, and then at maturity, apart from giving $100, it will also return the $1,000, which is also a cash flow. So the question we're trying to address in the chapter is to determine the value, the valuation of this instrument, to determine the value of this instrument today at time zero. So if you think about it from what we did in the previous chapter, what we are doing here, we are simply determining the present value of all these cash flows. So the present value of the cash flow, so the present value of $100, and also the present value of $1,000, because it's also a cash flow. But keep in mind, the $1,000 is to be received 20 years from today. The $100 is being received every year. So this is an annuity, and this is a single amount. So keep that in mind, right? So so as I mentioned, then the the bond valuation is based on determining the present value of the interest payments and the present value of annuity payments. So again, we just apply chapter, the previous chapter. We can determine the value of this instrument by determining the present value of the interest payments and the present value of the single amount. Now, to determine the present value, we determine the present value. We're just discounting these future cash flows. We're discounting these cash flows. But to discount them, you have to use the yield to maturity, or what we call the ongoing market rate of interest of interest. So we discount all these cash flows using 8%, because 8% is the yield to maturity. So keep that in mind. So we only use the coupon rate to determine the interest payments, and we use the yield to maturity to determine the present value of those cash flows. Now, to do so, you can determine the present value by either, again, use of financial calculator, use of Excel, use of financial formulas, So there's so many methods you can use to determine the present value. The other part I want to address or mention is when it comes to preferred stock, just keep in mind, this being another asset, is the determination of the value of a preferred stock is based on the dividends. The same is also for common stock. A common stock also pays dividends, and therefore the valuation of common stock will also be based on the cash flows, which is in form of dividends. To determine uh, uh, the value of a preferred stock, the value of a preferred stock, we are simply, again, we're assuming here the preferred stock is paying constant, the same amount of dividend every year. If that's the case, then the value of a preferred stock will be, you will take that dividend being paid and divide this with the required rate of return, what I just called KP. The required rate of return on preferred stock, which is KP. So you divide the required rate of return into the dividends. This will give you the price of the stock. As for the case of common stock, when it comes to valuation of common stock, so this is what we do. For common stock, if you know all the dividends, because really what we are doing with the common stock is this: we are trying to determine the present value of future cash flows. So if you know the dividends to be paid later in the year, also to be paid maybe the second year and the third year and the fourth year and the fifth year, then you just need to determine the present value of all those dividends, and that will be the present value of common stock. So if you know the dividends, if you know that will be the present value will just be, you'll take the dividends to be paid in year one, you find the present value of this. So it will be, again, what we have just done in the past is 1 plus, let's KE is the required rate of return, you know and then you also, if you know what will be paid in year two, then will be, again, we discount this to the present, and we do the same thing for year three and discount this back to the present. Again, here we're assuming that you are paying different amount of dividends every year. If that's the case, then this formula, you're basically discounting each of the dividend back to the present here, and we just sum them together, and the this will give you into infinity, and this will give you the present value of this particular instrument, which is the common stock. If you know specifically dividends will be paid in year one, year two, year three, year four. Now keep in mind that our D1 is basically what has already been paid, plus, if there's any growth, then it will be plus 1G. You know, assuming there's some kind of constant growth. So if the dividend has a constant growth, so the dividends grow at a particular rate, let's say 10%, 5%, 8%. If the dividends uh, grow constantly, then we sum up this formula by saying that you can determine the present value of the common stock by, so the value today will be, you'll take the D1 and you divide this with the KE minus G, where, of course, where G is the constant growth rate, which will be 8% or 10% and so on. And D1 is the dividends to be paid later. And KE is the required rate of return on equity. And therefore, your D1 in this case will be your dividend that has already been paid plus 1 plus G, that 8% of that growth. So this yields the D1. If you are looking at D2, then D2 will be the D naught plus the first year growth plus the second year growth. So this will yield to D naught into 1 plus G raised to a power of 2. Just keep that in mind, especially remember here you're looking for the P naught, which is today. Sometimes you might be asked to determine, P3, 3 years from today, and therefore to determine P3, you'll need to use D4, and you divide this with KE minus G, and therefore to determine D4 we have to take the D naught. So you have to take the D naught times 1 plus G, right? And raised to a power of 4 and KE minus G. And this will yield the price or the value of the common stock, in year 3, and so on and so on. Again, it's a very simple process. You just have to know how to apply it, and you'll be fine with most of the problems in the chapter. But that's how we value some of these instruments. Again, and then of course on the flip side of this is the required rate of return, which I mentioned again. If you are the provider of funds, you require some kind of return. So that's what you're looking at. If you are the borrower, then to you it becomes a cost of capital. So again, spend some time in the chapter and let me know if you have any questions.